If you are an investor, does it matter which country you live in? Is it better to be an American investor with access to the S&P 500 or a British investor with the FTSE and a global mindset? After watching this entire video, you will know the real answer based on decades of data, and more importantly, you will understand how to invest no matter which side of the Atlantic you call home, because the truth might surprise you. Let me start with a confession. When I first started investing, I was jealous of Americans. I thought they had all the advantages. The S&P 500, the NASDAQ, the tech giants that dominate the world. Apple, Microsoft, Nvidia, Google. I thought being a UK investor meant settling for lower returns and boring dividend stocks. But after years of studying the data and investing my own money on both sides, I realized that my jealousy was misplaced. Both countries have advantages. Both have disadvantages. And the smart investor learns to use both. So let me compare these two investing worlds honestly, starting with the United States. The U.S. stock market is the envy of the world, and for good reason. Over the last century, the S&P 500 has delivered average annual returns of about 10%. That means money doubles approximately every 7 years. If you had invested $10,000 in 1980, you would have over $800,000 today. That is life-changing money from a single lump sum and no additional contributions. Why has the U.S. performed so well? Because the U.S. dominates innovation and global capitalism. The largest companies in the world by market cap are overwhelmingly American. Apple alone is worth more than the entire stock markets in most countries. When you buy the S&P 500, you own a piece of the companies shaping the future. Technology, healthcare, finance, consumer goods. And those companies sell products and services all over the world. So you are not just betting on the U.S. economy. You are betting on global growth through American companies. But there is a catch, and the catch is valuation. Because the U.S. market has performed so well, it is often more expensive than other markets. The price-to-earnings ratio, which measures how much you pay for each dollar of earnings, is typically higher in the U.S. That means you are paying a premium for those American companies. And when you pay a premium, future returns can be lower. The last decade of U.S. outperformance does not guarantee the next decade will be the same. Now, let me look at the United Kingdom. The UK stock market is different. It is cheaper, for one thing. The FTSE 100 often trades at lower price-to-earnings ratios than the S&P 500. That means you can buy British companies for less relative to their earnings. And the FTSE 100 is known for dividends. Many UK companies pay higher dividends than their American counterparts. If you are an income investor who wants cash flow now, the UK market can be very attractive. The FTSE 100 is also more global than many investors realize. Companies like Unilever, BP, Shell, and AstraZeneca do business all over the world. When you buy a UK-listed company, you are often buying a global business. So you get international diversification automatically. But the UK market has lagged the US in recent decades. The FTSE 100 is heavily weighted toward older industries like energy, mining, and banking. It has less exposure to the high-growth tech sector that has driven U.S. returns. If you had invested only in the FTSE 100 over the last 20 years, your returns would have been lower than if you had invested in the S&P 500. That is just a fact. So which country makes investors richer? The answer depends on when you look. If you look at the last 15 years, the U.S. absolutely crushed the U.K. The tech boom, the recovery from the financial crisis, the dominance of companies like Apple and Microsoft. It was not even close. An American investor who just bought the S&P 500 did very well. But if you look at the last 25 years, the gap narrows. And if you look at certain periods, like the 2000 to 2010 decade, which Americans call the lost decade, the U.S. market went nowhere while the UK market actually performed better. The point is that past performance does not predict future results. The US has had an amazing run, but valuations are high. The UK has lagged, but valuations are lower and dividends are higher. So what should you do if you are a UK investor? Should you ignore your home market and buy American? Or should you stay loyal to the FTSE? And what should you do if you are a US investor? Should you ignore the rest of the world and just buy what you know? Let me give you my honest answer based on both data and common sense. For UK investors, I believe you should have a home bias, but not an exclusive one. The UK gives you tax advantages through the stocks and shares ISA that you cannot get elsewhere. And investing in your home currency avoids foreign exchange risk. But limiting yourself only to the UK means missing out on the largest companies in the world. So my recommendation is a global approach. A fund like VWRP, which is Vanguard FTSE All-World UCITS ETF, gives you exposure to both the US and the UK and the rest of the world in one fund. You get the US growth, the UK dividends, and emerging markets all together. Or you can do a combination. Perhaps 60% in a global fund, 20% in an S&P 500 fund, and 20% in a FTSE All-Share fund. That gives you diversification while keeping costs low. For US investors, the temptation is to ignore the rest of the world because the US has done so well. But that is a mistake. The US stock market is about 60% of the global stock market. That means 40% of the world's investable companies are outside the US. By ignoring them, you are missing opportunities, and you are putting all your eggs in one basket. The US has had an incredible run, but no country dominates forever. In the 1980s, investors thought Japan would take over the world. The Japanese market was the envy of everyone. And then it crashed and did not recover for 30 years. That can happen anywhere. So US investors should also consider global diversification. A fund like VT, which is Vanguard Total World Stock, gives you exposure to the entire world. Or you can keep most of your money in the US, but add an international fund like VXUS for diversification. Now let me talk about the practical differences between investing in the US and the UK that go beyond returns. In the US, you have the Roth IRA, which I have mentioned before. After-tax money grows tax-free forever. That is an incredible wealth-building tool. You also have the 401k with employer matching, which is free money. And you have access to some of the lowest cost ETFs in the world. Vanguard and BlackRock offer funds with expense ratios as low as 0.03%. That is almost free. In the UK, you have the stocks and shares ISA, which is also incredible. £20,000 tax-free every year. No capital gains tax. No dividend tax. That is better than almost any other country in the world. You also have the lifetime ISA if you are buying a first home or saving for retirement, which gives you a 25% bonus from the government. That is free money. And you have access to low-cost funds from Vanguard UK, iShares, and others. The fees are slightly higher than the US, but still very reasonable. There is also the difference in dividend taxation. In the US, qualified dividends are taxed at preferential rates for most investors. In the UK, you have a dividend allowance and then pay tax based on your income bracket. But inside an ISA, you pay nothing. So the key in both countries is to use your tax-advantaged accounts first. Let me share my personal portfolio so you can see how I apply this. I am a UK-based investor, so I use my stocks and shares ISA every year. Inside that ISA, I hold about 60% in a global all-cap fund, 20% in an S&P 500 fund, 10% in a FTSE 100 fund for dividends, and 10% in individual stocks that I research myself. That gives me exposure to the US growth engine, UK income, and global diversification. I also hold some US listed ETFs in a taxable account because I want access to certain funds that are not available in the UK, but that adds currency risk and tax complexity. For most people, keeping it simple with global funds inside tax wrappers is the best approach. Now I want to address the emotional side of investing across countries. When you are a UK investor watching US markets soar, it is easy to feel like you are missing out. You see headlines about the Nasdaq hitting all-time highs, and you wonder why you bothered with boring British stocks. But chasing performance is how people lose money. When you buy after a big run, you often buy at the peak. The smart move is to stick to your plan, stay diversified, and ignore the noise. And if you are a US investor, do not become complacent. The last 15 years have been amazing for you, but markets move in cycles. There will be periods when international markets outperform. There will be periods when the US lags. By owning the whole world, you capture returns everywhere and you smooth out the volatility. Let me give you a historical example. From 2000 to 2009, the S&P 500 lost money. It was a lost decade. But during that same period, emerging markets boomed. Gold boomed. Commodities boomed. An investor who only owned US stocks had a terrible decade. An investor who owned the world did much better. That is why diversification is the only free lunch in investing. So here is my bottom line. Do not try to predict which country will win. You will be wrong. I will be wrong. Everyone will be wrong. Instead, own the whole world. Use your tax-advantaged accounts. Keep your costs low. Stay consistent. And let time do the work. Whether you are in the US or the UK, the principles are the same. Spend less than you earn. Invest the difference in diversified, low-cost funds. Use tax shelters. Ignore the news. And wait. That is how you build wealth in any country. I want you to think about something. The financial media constantly pits countries against each other. US versus UK. China versus America. Developed versus emerging. But this is a game designed to make you anxious and keep you watching. The truth is that the global economy is interconnected. American companies earn money in Europe. British companies earn money in Asia. When you buy a global fund, you are not betting on one country. You are betting on human innovation and productivity everywhere. And that is a bet that has paid off for centuries. So stop worrying about which country is winning this year. Focus on your savings rate, your discipline, and your time horizon. Those are the things you control. Everything else is just noise. If this video helped you understand the difference between US and UK investing, hit that subscribe button right now, because on Next Gen Wealth, we break down these complex topics into simple action steps for investors on both sides of the Atlantic. And comment below with either US or UK so I know where you're investing from, and tell me one thing you learned from this video. I read every comment, and I want to hear your perspective. And click this video right here, where I show you the 5 assets that make people rich, so you know what to buy once you have decided where to invest.